Well, banking regulator APRA has cracked down on risky home loans by forcing banks to strengthen their loan serviceability assessments. What does all that mean? Well, joining me now is business reporter Edward Boyd. Ed, essentially this means that APRA has made it more difficult for Australians to borrow larger sums of money.
Yes, they have changed their loan serviceability requirements. So this week, APRA wrote to Australian banks with these new guidelines. And what they mean, if we can bring them up on the screen, is you need to now, when you assess a home loan, the person must be able to pay off that home loan at a rate of 3 percentage points above the interest rate they're paying. This has been increased from the 2.5 percentage points it was previously. And these changes are for new borrowers. So with home loans averaging about 3.2% at the moment, this means someone wanting to take out a new loan will need to be able to afford the repayments at 6.2%. So if that loan was $500,000, that would be roughly $2,160 a month in repayments at 3.2%. But if you increase it to 6.2%, that's $3,060 a month in repayments. So it's another $900 a month in repayments on a home loan that's $500,000, which is below the average size for a home loan. So it's a pretty significant increase for new borrowers. This is a little quote here from the chairman of APRA, Wayne Byers. He's the leader of the organisation putting in these changes. In taking action, APRA is focused on ensuring the financial system remains safe and that banks are lending to borrowers who can afford the level of debt they are taking on, both today and into the future. So remember in the past, APRA used to have an interest rate floor where you would only be able to be granted a home loan if you could afford to pay it off at a rate of 7%. That was the interest rate floor. APRA removed those guidelines in 2019 and brought in this interest rate buffer. Back then it was 2.5%. Now today they've increased that buffer from 2.5% up to 3%.
Really interesting indeed. Ed, APRA is taking action now, obviously, but house prices have been rising sharply for more than 12 months?
Well, that's right. So CoreLogic released their data just last week showing that property prices have risen 20% over the last 12 months, so in the 12 months to the 1st of October. And the average size of a home loan has increased significantly over that time period. According to the Bureau of Statistics, a home loan now, a new home loan being written, is of about $570,000. So APRA, in their media release this morning, said that roughly 20% of new loans in the June quarter were written to people and their loans were 6 times the size of their pre-tax income. Wow. That's a problem for APRA, and they say that statistic would keep getting bigger and bigger unless they decided to take some actions to curb the housing market. But APRA today say the changes they're putting in place are most likely going to affect investor loans. They're not as likely to affect first home buyers. The reason for that is investor loans are usually much larger loans that investors take out to buy property. So APRA believe this is going to have a little bit of an impact on the investor loan market and not so much on the first home buyer market. But the key question, Laura, is interest rates. The Reserve Bank, they met yesterday, said interest rates will be on hold at the record low of 0.1% until 2024. But we can we know that banks will be lifting interest rates before that date. As the economy improves, they are going to eventually raise interest rates. And if the economy bounces back sharply, like the RBA is expecting, then we could see interest rate rises at the end of next year.
That's really interesting because banks have been moving incrementally and quietly on their fixed loans and the interest rate for quite some time. You know, not hugely, but it's significant enough. Just quickly, what is this? You know, if you look at conventional wisdom, what is this move by APRA expected to have in terms of the impact on the housing market?
Well, APRA are kind of funny in their statement today. They say this is not about skyrocketing property prices. We're not here to try and clamp down on property prices. They try and make it clear all that they want to do is make sure that mortgage risk is reduced in the market. They don't want to see risky mortgages out there. So that's their strategy today by raising this interest rate buffer from 2.5% to 3%. But just a couple of months ago, Laura, there was lots of speculation that interest rates would rise at the end of next year, and then the Delta lockdowns hit the east coast of Australia. That's been now pushed back. However, the economy is reopening in New South Wales in a few days' time, and it's going to bounce back very sharply. The RBA is expecting a hiring spree and employment boom over the next couple of months. Economic growth is going to be fast-tracked, and we could see interest rates rising in 2022. And if that happens, APRA want to have these buffers in place now so there isn't a huge risk to credit at that point in time.